Thanks, Jerry. Thank you for your attendance. It's very kind of you to stay. I recognise it's late, so I'll keep it brief. I won't run through the normal tonnes and grade and long list of exploration results. I won't bore you with a mine-by-mine diatribe. But what I want to talk to you about this evening is our strategy. The most important part in understanding evolution and the value growth that we offer is understanding our strategy. It's more important than understanding our mines, because the one thing that hasn't changed in the 7 years since inception is our strategy. Sorry, I must warn you, I will make forward-looking statements. I would note, though, that evolution does have an unrivalled reputation for meeting or exceeding its forward-looking statements. Our ambition since we took management control of Conquest Mining in 2010 has been to create a globally relevant mid-tier gold mining company based in Australia. Why mid-tier? It's a fact that over the longer term, mid-tier companies as a group have outperformed both majors and juniors. We are big enough to be able to fund our own growth as well as deliver stable returns throughout the cycle, yet small enough that exploration, operational or acquisition success translates to share price appreciation. Mid-tier, broadly defined as a company with an enterprise value in the range of $2 to $7 billion US, an annual production in the range of 700,000 to 1.4 million ounces. We fit squarely within this range with an enterprise value of $3.5 billion, an annual production of 850,000 ounces. Our other vital statistics, we have cash and undrawn debt facilities of $240 million. Gearing is at a manageable level of 22%. We have a prudent level of hedging in place, and we pay a semi-annual dividend. On a global basis, we stand out on most multiples, particularly all-in sustaining cost, cash flow and EBITDA. The transformation of evolution over the past couple of years, though, is still to be fully recognised by investors. We believe Australia is a fantastic place to operate, a transparent permitting regime and easy access to a specialist mining workforce. It is due to that specialist mining workforce, through the productivity and efficiency that only a specialist mining workforce can deliver, that Australia is low cost. Australian mining is globally competitive. Evolution will produce between 800 and 860,000 ounces this year at an all-in sustaining cost in US dollar terms of $675 to $720 per ounce, making us one of the lowest cost gold mining companies in the world. Australia, as you know, is the second largest gold producing country in the world. I couldn't think of a better place to build a gold mining company. I couldn't think of a better place to explore. We believe significant prospectivity remains in Australia. We are often labelled as having mature mines, yet we've had no trouble maintaining or increasing our reserves year after year. We are absolutely convinced that there are many more ounces to be discovered in Australia. Our exploration effort is focused in the Eastern Goldfields, the Lachlan Fold Belt and the Mount Isa Inlier. We currently have a gap in our exploration pipeline, and we're actively looking for joint venture opportunities in these regions in particular. Evolution was built through M&A. It started with the hostile takeover of North Queensland Minerals and a deal with Heemskirk Minerals to acquire Pajingo. The value add was in unwinding the oppressive JV ownership at Pajingo and in recapitalising that mine. The turnaround at Pajingo under our ownership was actually much quicker than we'd anticipated. Next came the acquisition of Mount Rawdon and an interest in Krakow from Newcrest, and the merger with Catalpa to create Evolution. Again, the value add was clear. Newcrest's unloved assets of Mount Rawdon and Krakow quickly became stars in our lineup as we applied a leaner operating style. Then there was a 3-year hiatus. We reviewed a number of opportunities during this period, but nothing met our requirement of improving portfolio quality. We remained disciplined and waited for the right opportunity. So, fortunately, our powder was dry when Mungari and Cowal the Mungari and Cowal opportunities came along in 2015. At Cowal, we've been able to add significant value by reducing costs and extending that ore body at depth. You will have seen that we have recently committed to the Stage H cutback at Cowal, securing the life of that operation out to at least 2032. Cowal had a reserve of 1.6 million ounces when we acquired it in 2015. It currently has a reserve of 3.2 million ounces. 1.6, 3.2. At Mungari, we have added value through the acquisition of the Phoenix tenements and the potential to materially extend the life of the operation through exploration success. We maintained the pace into 2016. We knew that 2016 was going to be a difficult year for M&A in the gold space, as will this year, I expect. As prices ran up, it was a seller's, not a buyer's market. So we turned our attention to gold assets owned by non-gold companies, and we sold an asset, Pajingo. Last year, we struck up a conversation, at about this time last year, we struck up a conversation with Glencore at what proved to be exactly the right time. Timing's everything. Base metal and bulk commodity prices were low, and Glencore urgently needed to sell assets to fix its balance sheet. We were able to acquire an interest in a Tier 1 Australian mine cheaply, with future upside from depth extensions to the ore body, Ernest Henry remains open at depth, and regional opportunities. It dramatically increased the quality of the portfolio and cements Evolution as one of the lowest cost gold producers globally. Throughout the journey, we've remained disciplined and true to our strategy of building a mid-tier, globally relevant Australian gold mining company. We have chased opportunities. We haven't been scared or blinded by perceived risks. The best example of this is Mount Carlton. When we took control of Mount Carlton in 2010, it had a failed feasibility study and a report from Brooke Hunt saying the concentrate was unsaleable. This year, it's on track to produce 100,000 ounces of gold at less than Aussie $700 an ounce. We are not scared of risk. Instead, we seek to understand the risks of new acquisitions and then deal with those risks head on. No acquisition is without risk, and to look for an acquisition with no risk will just mean that you'll spend a lot of time looking. Managing risk is what ultimately makes an acquisition successful. We've used stepping stone transactions to build Evolution. We couldn't have done the Catalpa and Newcrest deals without Pajingo. Pajingo was the stepping stone to Cracow and Mount Rawdon. We couldn't have acquired Cowal without the support of Naguib Sawiris. The Mungari transaction was therefore the stepping stone to Cowal. The acquisition of Phoenix Gold was an obvious next step once we had locked in the acquisition of Mungari. Essentially, every deal has paved the way for the next deal. And that's how we continue to assess opportunities. We consider what the opportunity will allow us to move on to, whether that's a new region, a new capacity, or a new relationship. Business development must improve the quality of the portfolio, which means either reduce average all-in sustaining cost, increase the average mine life, or increase average production. So if we look at our FY17 guidance and divide that by 7, our average asset produces roughly 120,000 ounces of gold at an all-in sustaining cost of 930 Aussie dollars an ounce, and it has a mine life of at least 8 years. So that's effectively our hurdle. Any new asset must improve at least one, if not all 3 of those metrics. In terms of importance, mine life and cash costs are the most important attributes as we continue to build a sustainable business that can prosper throughout the cycle. Acquisitions must be value accretive, which is self-explanatory, ideally opportunistic. We need to be able to add or unlock value, and logical additions to the portfolio. Hence, we prioritise Australia, gold and operating assets, our areas of strength. That said, we are open to other opportunities. Evolution has the capacity to generate, execute and integrate M&A opportunities. We have an overriding discipline that transactions must improve our average asset quality and must be value accretive, opportunistic and logical. As this diagram shows, we have successfully improved the quality of the portfolio over time, acquiring at the top right, divesting at the lower left. Moving forward, we will continue to stick to our strategy. We have a great organic growth opportunities, so we're under no pressure to grow inorganically. That said, we will continue to assess acquisition opportunities, and we will continue to be very selective in the opportunities that we decide to chase. We will remain disciplined and aim to avoid the overwhelming bias for action. Thank you for your time.
Thank you, Aaron, and once again, congratulations to Evolution Mining on winning the Craig Oliver Award. That wraps it up, ladies and gentlemen. A big thank you to Shane and Sam down the back, to Prue and Andrea